Welcome once again, friends, to a fresh episode of Working with Gen Z. Happy New Year to all of you. This is our first episode of season two for the new year. As we think about the new year, one news which has been making headlines is the sheer amount of layoffs that we are seeing in the corporate world today, especially in the US, and certainly also a lot of the ed tech e-commerce firms in India as well. And therefore, the corollary to that would be to say that if you are one of the employees who are affected, certainly not a good position to be. And a lot of the people, in fact, when I think about the people impacted in India, are also what we call freshers or new joinees. And it brings up the conversation that it is not a good position to be in if you're impacted, and what does it mean for you if you're the unfortunate one, and how does it impact your life, especially financially, right? And do you foresee something like this? Nobody certainly plans for it, and that will be the focus of our conversation today, which is to say that what is the importance in the relationship of money in life? We all know that, but there are many, many events that come, some planned, some unplanned, which can throw us off guard. And we will dive deep looking at this event of layoffs as a way to understand our money habits for the Gen Z generation in particular. We'll examine more generally and perhaps look at that the money habits of other generations have been different given their circumstances and the context. But if you are a Gen Y or a Gen Z, you have added knowledge, you have added information. But to be in a situation what's happening now, or even generally, what does that mean to you? And so to examine that, I have my guest today is Mr. Mithun Chital. Mithun, good morning and welcome to you.
Good morning, Nikhil bhai. Thanks for
Yes.
having me here. Good morning.
Yeah. Pleasure, Mithun. And so we will kickstart our discussion, and I want to read and get our viewers to know the rich background Mithun Bhai comes. So allow me a moment to quickly give a short profile of Mithun. He's worked a career which is over 21 years and has served in the financial services industry with a lot of well-known corporates such as ICICI Bank, HDFC Life, Tata AI Life. And in one of his prior roles at Tata AI Life was the assistant vice president, and doing roles in places with bank insurance, a broking corporate agency, and he's also now the founder of Client First, a firm which helps serve and give financial guidance to clients engaged in distribution of financial solutions such as mutual funds, life insurance, structured products, company deposits, and so on. Client First has been there for over 15 years and has also been, recently or been educated as the most responsible distributor honored by Cafe Mutual. They have clients, 1,000 clients in panel in India and abroad. A lot of the work that Mithun Bhai does has been featured into very, very prominent publications like DNA Money, Hindustan Times, UTI Swathantra Publication, and so on. Mithun Bhai himself has an MBA in marketing. He's a certified financial planner and has lots and lots of other relevant financial certifications and experience to help clients achieve their financial goals. So Mithun Bhai, once again, welcome and Happy New Year to you and hope all is well.
Hey, absolutely all is well, Nikhil bhai. I hope you and your family are doing well as well, and Happy New Year to all our viewers as well who are going to view this, view this basically program, this workshop program.
Yes. Excellent. So, Mithun Bhai, I have a lot of questions. Of course, this is a topic near and dear to all of us, both as professional, as parents, and there are many, many things that I have. So let's kickstart. But before we go into our questions, as we've done with past episodes and as our routine, help us and tell us a little more. I, of course, may not have done full justice to your intro, but tell us a little bit more about yourself as well as the work that you do.
Well, so I always thank God every day that God has been very, very kind and very, very lucky. Why? Because there are very few people like me, I would say, whose passion is their profession. So with that passion, keeping in mind that passion, I actually, founded Client First. It's a firm which is about 15 years old now. We are basically engaged in distribution of multiple financial products, such as you highlighted, mutual funds, company deposits, life insurance, general insurance, structured products dedicated for our HNIs and ultra HNI clients. In a very single statement, if I have to say the mission of Client First, I would say it is to encourage people, is to help our clients basically in a very, very goal oriented approach. I think that is something which has the heart of Client First, and we hope to take it forward for many, many years to come now.
Excellent, lovely, Nitin bhai. So let's get underway. I began the episode by certainly talking about the sad news or the news of layoffs which we're hearing in the U.S. The amount is about 100,000, and then another 100,000 happened in December and November. So that has an impact. But I want to shift focus, so we'll come to that maybe as to if you get into that situation, what do you do? But let's rewind back even further to say that, I think when you think about somebody like you and myself, when we were growing up as young children, perhaps growing up, life was much simpler. We didn't have as many choices, and maybe that we could look back to say was a blessing in disguise. But the younger generation, the millennial generation and the Gen Z generation, certainly has so many more choices. And in many ways, if you see how India has progressed, it's changed the landscape in so many ways, in a good way, right? So the consumerism or the growth of consumerism has happened so drastically, right? And that can be a good and bad thing. And so from your perspective, Mithun, what is your view when you see that now as a consumer, if I have so many choices, what does that do to me? And in terms of a consumer, and what trends are you seeing just simply as sort of the big picture, overview of with the people and money when it comes to having all these choices now, because you also have the choice, right? So let's talk about that first, and then we'll go slightly deeper.
Sure, Nikhil bhai. I think very, very interesting question to start our conversation itself. Well, I would like to answer it in such a way that let me kind of differentiate between the older generation, generation of ours and maybe our fathers and my grandparents, and the younger generation, whom we refer to as the Gen Z. People generally who are between 10 to 25 years of age. If I talk about the old generation was essentially characterized by a society, or specifically from a financial perspective, there was lack of information. There was information paucity. Okay, they were not aware about so many products, etc., etc., and hence, when I see my father or my grandfather or the generation in that era, since they had lack of information, the investments which they did, the money management which they did, was very, 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 very confined to a host of traditional products. So if you ask them, it is basically related to life insurance, the post office deposits, the KVP, the NSC, investing into gold, and that is something which was heavy characteristic of that generation. At the same point in time, they believed in high percentage of savings as a percentage of their income vis-a-vis high percentage of spending their income. So that is one thing which was very, very true to that generation. They believed in a lot of face-to-face communication. So today, even if I meet clients in that generation and not the younger generation, they believe more, Mithun bhai, let's come and meet over a cup of tea or coffee, and let's discuss our financial plan. So they believe in more of face-to-face communication. Their orientation, which I actually saw and I'm still seeing today, is more towards the long-term goals. Okay, rather than instant gratification. It's more tailored towards long-term goals. And one very important characteristic which I can still see in the older generation is debt was considered as a taboo. Whether we need to take debt or not, should we have a loan or not, was considered to be more of a taboo. Whether we should take it or not, what the society will say about me, blah blah blah.
Right.
So this is something which I would say about that generation. Now coming to our topic, I think it's completely different for the Gen Z. If I take the same points, it was information scarcity for the older generation. I would say for Gen Z, there is information truckloads of information which is available, and that is the reason why they at times get confused that what to do. As far as their investment choices are concerned, they believe more into new age instruments. Okay, unlike the good old traditional instruments, the younger generation believes into researching on their own. Everything is available on the fingertips on a mobile screen. So they love to invest into new age instruments like a mutual fund, structured products, cryptocurrencies. Obviously, we'll discuss whether they're suitable or not, but that's what the Gen Z is actually into. Uh, in terms of the spending habits, they are more into spending, as compared to savings, which the earlier generation was characterized of. They believe more in the online way of communication. At times I find the Gen Z simply running around, simply busy, whether they are, I don't know whether they're into a rat race or not. So they believe in online communication. So, Mithun bhai, let's do a video call and finish this off rather than when can we meet face to face. That's
Right.
that's a huge difference which I see. Again, instant gratification is something which always excites them. Today, if a Gen Z person, whenever he joins a job at the age of 20, 21, 22, the first objective would be when can I buy the next Apple iPhone?
Right.
When can I buy the next latest MacBook, which has come to town? So that is something which excites them, and they are very very acceptable to taking debt in their life. Unlike the earlier generation, wherein they used to feel, are we doing a bad thing in taking debt? I think they are very very comfortable in taking debt. And one last word which characterizes the difference is basically the younger generation doesn't simply have patience.
Sure.
Whereas the old generation used to have a lot of patience. Today's generation has a lot of information available, but at the same time, there's lack of patience. So I thought, let me discuss this part with you, wherein
Yeah.
I could see a huge difference in both of them.
Yes. No, absolutely. And I think I'm going to ask you a little more on the part about patience and the fact that they want instant gratification. So let's come to that in a moment. But before I go there, Nitin bhai, in India, of course, we are a very complex country. A lot of different kind of demographics that one can find
Yeah.
an urban city to a tier one to tier two. And, of course, the information access is there. We like to think to everybody, and India has made so many strides in digitization of, the day-to-day life and so on. But a question that I normally always ask when you think about the Indian context is that do you sense or do you see, and of course you have clients both perhaps in rural and urban kind of a setup. Is there a distinction or a mindset difference between the urban young Gen Z versus the rural young Gen Z? And how do you see them, and what could be driving some of that?
Yes, there is a very stark difference, Nikhil bhai, between what we notice in our urban clients vis-a-vis our rural clients. To describe it in a very brief pointer, I would say the urban client is more independent when it comes to his or her decision making. Not necessary that they take all decisions which are absolutely right and very very logical, but still they would go with an independent decision making approach. When I still meet my rural clients, they still have an approach that my father was managing my money, or my grandfather was managing my father's money and also advising me. So I have seen them taking the advice of their elders and then basically executing that decision. So still I would believe there is this demarcation between an urban client of ours versus a semi-urban or a rural client of ours. I think that's one major difference which I notice.
Sure. Right. And so let's talk immediately about, I want to shift our focus on, like, how do we now, since our focus is Generation Z, and you mentioned that there is lack of patience, but there is also familiarity with technology, and that can be also a positive, right? Because I still know I mean, people of certainly of our generation are using technology, but maybe our parents, they would still prefer to go into the branch or call the relationship manager to,
Absolutely, absolutely, yeah.
and when some of it could be done at home as well. So let us understand now, how do we uh, help, as you mentioned in the initial context setting response, is that they are attracted towards new gadgets. They want to see and buy something immediately. They're quite happy taking on debt without worrying about what the society may think. But perhaps could it also be that they are not simply aware of what debt can become,
Yeah.
or what savings can become on the other side if that done right. So I'd like to, Mithun bhai, let's go take this question a little in some detail to help our viewers to understand maybe three or four aspects. One, of course, is the aspect of planning, right? Which is quite essential. So if you can help, let's understand that a little deeper. That's planning. Then of course savings, the role of savings, and some basic tips there. Of course, then we talk about debt, and then of course investments. So let's start there.
Perfect, Nikhil bhai. So I think I would always say that let me share my own budgeting sheet. I
Okay,
always do it
sure,
with my clients because I think that is something which, let me just share my screen.
sure.
Yeah, I hope it is visible.
Yes, I can see it.
Yeah. So it's a very simple budgeting sheet of mine, which I am just disclosing along with all the amounts. It's exactly the way it is. What I have done basically, Nikhil bhai, is I've divided this budget sheet into four columns, as you can see. The first is the expense head. Where am I spending upon? Which contains close to about 35 to 40 items. I believe I've included everything possibly, whatever I could do. Second is when do I incur those expenses? As an
Mm.
individual, when do I incur those expenses? Does it happen every month religiously, like an auto debit or something which I am compelled to pay? Whether it happens quarterly, whether it happens once in 2 months, yearly, etc., so on and so forth. The second last column is basically the expense category. So
Mm.
whenever I am incurring these expenses, is it fixed or is it variable? Okay, so my electricity bill could obviously vary in summers and winters and monsoons.
Yep.
My daughter's fees can still be fixed at least for a year or two till the time the school doesn't enhance it. So I've basically demarcated them into fixed versus variable. And what I have done at the end is I've basically put everything as if it would have been monthly. Okay, so just to give you an example, I pay my daughter's school fees once every 3 months, which is every quarter. Whatever I pay, I have simply divided it by three over here. So I'm able to
Mhm.
arrive at a monthly amount.
Mm.
Okay.
Mm.
The rationale for doing this is many a times when I interact with young clients, especially Gen Z, who have a very good income nowadays, fortunately. But
Mm.
when I ask them that if your salary is, say, 100 rupees, okay,
Mm.
what is your expense? So the
Mm.
first thing which comes to their mind is, it's the mental way of accounting. So the
Yeah.
first thing which they think is, hey, I pay this much of rent, this much of EMI, this much is this much is this is my maid fees, this is my cook fees, blah 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 blah. Okay, Mithun bhai, if my salary is 100, my expense is say 40.
Mm.
The immediate follow-up question which I ask them is, hey, that's great. Does this mean you can actually save 60 rupees per month? And then the client suddenly starts looking at me, or maybe in air.
Mm.
Oh, इतना पैसा तो नहीं बचता है मिथुन जी, which
Mm.
basically means at times we underestimate our expenses.
Mm.
Why? Because all
Sure.
expenses may not be monthly. Okay, if you look at my sheet, I'll just take you briefly through that sheet. There are so many items which we do not pay monthly. For
Yeah.
example, our insurance premiums, we don't pay monthly. We pay
Correct.
them maybe once every 6 months or majorly every year. Our car
Correct.
servicing we may do once every year, once in 6 months.
Yeah.
Vacation we may do once every year. Okay, so many expenses, festival expenses, so on and so forth. So it's better to prepare a monthly balance sheet. And when I do that, if somebody would have asked me that, Mithun bhai, what is your expense of staying in Ahmedabad with your family? I would have said maybe 80-90K per month. But
Mm.
when I kind of do the mathematics, I convert my annual divided by 12, quarterly divided by 3. I see a very different scenario, Nikhil bhai.
Yeah. Yes.
Okay, it's not about scaring me or anybody. It's all about being realistic.
Correct.
That this is going to be my average expense.
Yeah. So
Okay.
excellent point, Ms. Mike. Now, so just to reiterate again, there are lots of tools available, perhaps online as well. But can you guide for our viewers here? Again, I want to reiterate the importance of budgeting, right? So, if you've been in a habit of doing this, no, mentally, how should one get into this habit? Is there a place that they can go to, or can they create a simple Excel like you have done? Yeah.
I think the first thing which I would want to tell people is, the last 2 years, we've had a lot of different kind of expenses which may have come to our individual balance sheets. COVID struck in 2021, end of 2021, and continued for the better part of 21-22. So a very simple homework, once I share this sheet with my clients and with the people whom I meet, the prospects, I just tell them prepare a very similar sheet. How do you get an idea about this sheet? Very simple, just take a stock of your bank statement.
Mm.
Okay, just download the last 2 years or 3 years of your bank statements, and you will see a lot of things. You will see certain things which are more high on the medical part. You may see certain things which are more high on the discretionary expenses part. Just do that. And I mean, even if you are not perfect, like instead of 172 on my screen, if I would have prepared 150 or say 2 lakh, I would say it's okay. The whole idea is to just write it somewhere, see how it is actually happening. And I think that's how you'll basically be able to get a hang of it. Yes, there are so many online tools available, there are so
Yeah.
many apps available. You can even make use of that. Whole idea is to do it for 3 months, 4 months, and I'm sure you will, over a period of time, even if you then sit for 6 months or 1 year, you will get a hang of things for sure.
Yeah, yeah, and I think it's a good point. That way, it's a good way to confirm or validate your mental expense as well, right? Are you pretty close? Are you under? Like you said, most of us are actually probably always, underestimating or
Always underestimating. Yes, yes.
indicating the okay. Lovely. So that's great. Now let us. Anything else there, Mithun bhai, on the budgeting before we move? I'd like to understand also savings, right? What about savings, right? How
I
do
think Nikhil, by savings is in a way a step which is very much related to budgeting. If you do your
sure.
step one right, which
Yeah,
is basically budgeting, I think the savings will automatically come over there. Let
yeah,
me share a very simple slide which I have made,
sure.
and I'm sure it will throw a lot of light on income versus expenses. And we have different people in the society who manage it in different ways.
Yeah.
The question is, how do you handle your finances? So I would say normal people handle their finances in such a way that income minus expense is equal to zero.
Hmm.
I'm talking about very normal people who may not have so many savings,
Hmm.
are absolutely living, hand to mouth. Income
Yeah.
is almost equal to expenses, which are they are not able to save. Few people, especially again coming back to Gen Z, which I notice is they absolutely have, unfortunately, no financial control. Their income minus expense actually turns out to be negative, which is
Yeah.
basically debt. Okay, and we'll speak about it, as our talk progresses, that how people have actually gone to credit card, which I believe is the most expensive loan, but that's the sad reality. And this is irrespective of income, Nikhil bhai. I see Gen Z
Hmm.
is earning 20 lakhs, 25 lakhs CTC, but still income is less than their expenses, or expenses more.
Yeah.
So I hope these people come under the financial control after seeing our session.
Yeah.
uh, some responsible people handle finances at least in a way that income minus expenses, they're able to do some budget, some savings. uh, some disciplined investors believe income minus savings is equal to expenses. So first of all, as I talked about the older generation, they always believed
Wow.
in saving first and then spending later. And I hope to meet more and more, or I hope to convert more and more smart intelligent people who are actually doing income minus investments is equal to expenses.
Yes.
We know why savings account is called as a savings account and not an investment account, because there is a difference between savings and investments. So the question over here is, how do you handle your finances? Are you into, the I hope you should not never be into, point number two, because then you are completely out of control. Even if you are in point number three, I think that's a good step to begin with.
Yes.
And then obviously going into point fourth and fifth is something which, should be the ideal scenario.
Right. So how do we? It's a very interesting, Mithun, you talk about the fourth and the fifth bullet point here is how to look at, when you mention income minus savings and income minus investments first, right? So a generation which is so used to living in the today, living for now, and so on, right? How do you convince them, or in other words, what is the rationale, right? What do we tell them? That actually treat savings like an expense and put that away. I mean, it's not technically an expense, but it becomes like an expense, so that you're parking in a way so that there's a disciplined way of doing it, right? So how do we convince that, or maybe just to expand on the last 2 points?
Yeah, absolutely. So let me give you a real life example, Nikhil bhai. How we actually discovered it before we made this presentation is, so when I got married, and me and my wife obviously both continued to work, and we were working at that time. And she was spending from her own account, I was spending from my own account. At the end of the month, in spite of earning a decent amount, we obviously thought, why is the money not being saved? Why are
Hmm.
we always short of money, or why do we get tensed after the 20th of every month? At the time I was salaried, so we always used to feel, can the salary come on 28th instead of 30th? So we always used to feel like that.
Right.
So somehow then we said, let us do one thing. Instead of you spending from your account, I spending from my account, let us open a joint account. Let us open a joint account. So we opened a joint account in in one of the banks. And what we did was we linked my mobile number to that joint account and my wife's email ID to the joint account. So whenever I used to swipe my card, I used to go to the ATM and withdraw something, I used to get an SMS. My wife Niyati used to get an email. Okay, obviously, whenever you get the SMS in the email, it says 1,000 rupees withdrawn, the balance is blah blah blah.
Yeah.
Okay. So by around 50th or 20th, we used to notice that, oh boss, now we have a tricky situation, little bit tricky situation. Let us postpone at least the things which are not extremely necessary. Maybe instant gratification, maybe something which we can postpone to the next month by the time we earn our salary. Let us do that. So invariably, when we started this practice, yes, it was a little difficult for the first 2, 3, 4 months. But over a period of time, we realized that this is the budget which we need to kind of work upon. And as it is always said, we are children inside. Okay, so it is always said that if you reward yourself for any right behavior which you do, you will keep repeating the behavior again and again. So what we used to do is, in some of the months, if there was a 2,000, 3,000, 5, and I'm talking about 2,000, 6, 7.
Yeah.
So if there is even a 5,000 rupees which was left, okay, on 30th, okay, what we used to do is we used to go out and buy possibly a microwave oven, which was necessary for the house. We used to buy some utility things. So that basically gave us a very positive reinforcement that you can manage this. Just open a separate account, put whatever expense you think on the first of every month if the salary is on 30th. And I'm sure it will be a little tough, but I think over a period of time that will really work to your advantage. So that is how we actually managed it. And I thought, let me share my own story with you.
Yeah, no, what a great example. And I think it's just important for people to see the whole positioning differently, right? Rather than trying to say that, okay, I'm going to keep spending and I'll see how when it comes and what happens, right? Here you're taking a much more proactive view, but for that you have to be able to see the pattern, which is where we go back to budgeting, we go back to this and see the savings and investments, right? So we're going to come into how you take your savings and investments and how you can grow that next. But let's talk about, since we're talking about the 5 bullet points here, which is the income minus expense. So you see 3 times there, and which is to say that the expense not handled properly, it can become what you say is it becomes debt. The number,
absolutely,
right? So let's talk a little more there as to help us understand, the dangers of the trap of debt. And I'm sure we can talk till the sun comes down, but
yeah.
but just some basics of what should people do, not do, right? Debt is easily available. That doesn't seem dangerous until it becomes very, very dangerous, right? So talk us about debt.
So I would say that debt is not harmful per se. If you are taking debt for the right reasons, I think it can help you out, manage your life very, very well. So let's put in perspective a couple of principles which are very, very important. First is the kind of debts which are available right now. You have debt ranging from a home loan to a car loan to a personal loan, education loan, a consumer durable loan, and so many loans. I think the only debt which me as basically a distributor of financial solutions, I would say the only debt which is still much more logical to take is a home loan. Okay, why? Because we know that home loan requires a huge capital. Even in a city like Ahmedabad today, if somebody were to buy a decent 2 BHK or a 3 BHK, the property in an decent area would actually cost around 70 lakhs to a crore of that. So I think for that, obviously, a Gen Z or a person who has just started working and just started saving may not have that much quantum. So the only debt which anybody, I believe, should take is a home loan, a home debt. That too, it's very important that even when you take a home loan, do not squeeze yourself to such a way that basically you regret it later. So a simple thumb rule, Nikhil bhai, which I would like to share is that whatever is your take-home income, whether you are salaried, professional, businessman, whatever you are doing, do not take the EMI. Basically, the EMI on the home loan which is the only loan which I am recommending to take, should not go beyond 33% of your take-home income. So if somebody's take-home salary is say about 60,000 rupees a month, please manage it in such a way that your home loan EMI doesn't go beyond 20,000. Okay. Yes, banks will offer many things to lure you. India is in a good situation right now post-COVID. We are in the credit system is great in place. So banks may lure you. We'll give you 80%. We'll give you just pay 10%. We'll give you a 30-year loan. Please do not fall for all these things. Just make sure that your overall loan should not be more than 30% or one third of that. Number one. Number two, never take loan for a depreciating asset. Okay, a house we know for sure is obviously going to appreciate depending on the economic situation. But a car, for example, the moment you put a starter and you take a loan and you come out of a showroom, the asset is going to depreciate. So never take loan for depreciating assets. So two principles. One is limited to about one third of your take home income. And second is the only loan which you basically take is a home loan. Even if you have to delay it, maybe cough up more down payment, do so. Please do so. And that is the way you are able to take debt, own up an asset, create an asset which you will be proud of. But at the same time, it will not basically, spiral out of control. And then, as you discuss, layoffs and everything will further impact you. So keep that particular debt formula in check always.
Yes. So the one thing, Mithun bhai, which is perhaps just touching upon is that even I mean, just it seems like the one thing that maybe people are either grappling with or not aware, if you are in any kind of a debt, is that there is such easy access to credit cards today, and
Yep.
and you don't do the homework, they're charging you fees, and even banks are charging you fees for withdrawals, right? What are the downsides, or can you use credit wisely? In other words, credit card, one can argue to say, I'm buying a month's worth of credit, but I can just pay it off when I have to. Or should the young Gen Z just not take on that as a mindset and perhaps do it later in their life? What is your view?
So I think, as you said, we can keep discussing on and on, only on the topic of a credit card. But I am a firm believer that if you have debit cards with you, if you have a UPI system with you, I think let's not use the credit card as far as possible, because the good thing about a debit card is, as I said, immediately it will give you a message. This is the amount spent. This is what is remaining. You automatically, speak to your mind and you say, okay, hold on. I need to kind of postpone this if it is not absolutely necessary. A credit card, as you very rightly said, Nikhilba, is the costliest form of loan. For our viewers on this call right now, let me just update them that if you don't pay the credit card dues, and if you simply keep on paying that minimum amount, which many people, have a habit into, the interest can go as high as about 4% absolute per month. So just imagine paying a 48% loan. I think there's nothing costlier than that. And once you get into that debt trap, it just keeps, it's a vicious circle. It goes on and on and on. So first, if you are comfortable with debit cards and UPI, I think there is no harm in not taking a credit card. Number
Yeah.
one. And if you are taking that, then I think please make sure that you have only one card. I see people who are having four cards, five cards. There is one card for an airport lounge access. There is one card for a diner access. For there is something, and then they have more cards than the kind of bank accounts which they have, or the kind of
Yes.
number of family members which they have. Let's not enter into that trap. It's very easy to fall into it. Takes a lot of time, teaches you the lesson in a very, very hard way. So either don't use it at
Yeah.
all, or be very responsible in making the payment much before, I would say, and the full payment for
Yeah.
sure, not the minimum payment culture.
Sure, sure. So what you recommend is that rather than taking the credit, rather just make it directly, the debit card or the UPI system. Hopefully, because of that, you can be much more aware that, look, I had 10,000 in my account. I've already spent 6,000. In the credit card, sometimes it's out of sight, out of mind. You may not realize.
Yeah, yeah.
You keep charging, and all of a sudden now you get a bill of 5,000, and then you is a surprise to you, and then you go to pay minimum, and then you get into that spiraling circle. So good point. Okay, fine. Okay, let's talk now, Mithun bhai, about the final component, which is of course on investments and income. So we've gradually gone from budgeting. If you do have good habits, there leads to savings. If you are doing savings well, hopefully there is no debt, and all of that you understand. Now, how do you make the money grow? So again, it can be something we can talk very extensively, but let's talk about investments and help the Gen Z population.
Uh, I think great point. Investing. I think specifically for Gen Z, before where to invest, I think what is very, very important is where your money is getting eaten away, Nikhil bhai. Okay, so I always ask this client, my fundamental question to all our clients is, what is more important to you? Is it safety of money? Question number one, option number A, or option number B is it safety of value of money? Is it safety of money or is it safety of value of money? Because if you want safety of money, well, I think money kept in a locker would be the safest. But the problem is if you take out money after 5 years, 10 years, the 100 rupees will on paper remain 100 rupees, but its real value would have actually gone down much more on account of the inflation. So it's very important that when you choose any instrument for your long term goals, for your long term dreams, very important to understand and ask yourself this question: that is this instrument going to has the potential to beat the inflation? At the same point in time, has it the potential to be more tax efficient? I think these two are extremely important instruments. Nikhil bhai, let me be the let us reverse the role for about a minute or so, and let me
Sure.
ask you a question. Okay, the good old favorite fixed deposits, which all our father and our grandparents used to do and still have been doing, is can you just guess the total amount of fixed deposits which are lying in different banks across India?
Yeah.
Any vague idea?
Know the number at all, but my guess would be I'm saying Mithun bhai, strictly because the equities market over the last 3-4 decades has seen so much money come in, from retail investors, from domestic investors, FIIs, and so on. So I would like to think, and our viewers can probably hear the correct answer, is that maybe more money is going into those kind of instruments, because we're a growing country, growing economy. There are places and sectors in which investments is coming in, and we are a young country as well, which is to say that if you're young, you are in a position to take a little more risk rather than some societies which are aging societies. So I don't have a number, but I would probably say that it is tilted towards equity. Now you let me know.
You are going to be in for a big surprise, Nikhil bhai.
Okay.
First, let me tell you the number of equity, since you've started with equity. So if I talk about only the mutual fund industry, we're not talking about the direct equity or the structured products. If I simply talk about the mutual fund industry, it is close to a 40 lakh crore in terms of size. Out of this 40 lakh crore in terms of size, let me tell you that the equity mutual funds, something which is more glamorous, something which excites people when they see the advertisements and encourages them to invest more, is only close to about 14 to 15 lakh crore.
Oh, okay.
A larger portion basically is the non-equity part, which could be the hybrid part, which could be the bonds part. Okay, so this is 14, 15 lakhs in a universe of 40 lakh crore. Now
Okay.
let me tell you the FD universe. Okay,
Hmm.
so you consider all the public sector banks, you consider the private banks, foreign banks, even cooperative banks, and
Hmm.
you will be shocked to hear, Nikhil bhai, the data has just been published about a month ago in Economic Times. Uh, the total FD quantum, which is lying in different banks, is a huge 178 lakh crores.
Oh my goodness.
And I'll take some time to actually count the number of zeros after 178.
Right. So that's an absolutely astonishing number. I certainly wouldn't have even guessed the figure that you mentioned, the division of the equity versus fixed income in the mutual fund world, the portfolio. But now when you mention that such a large number, that what is, just quickly to on that question, what is your, who would you say is representing the investors there? Is it largely the older generation, or do you saying, or are you seeing, or is there data that suggests that maybe, a substantial portion of that is actually people who are in their younger ages but are not investing where they could be?
I think it's a combination of both, Nikhil bhai, to be honest.
Mm.
Older
Mm.
generation obviously used to have this love for traditional products, and obviously lack of information, which we have discussed in the first part of this program. Even younger generation today, who are, as I said, completely on their mobile phones, want faster decision making. But at the same time, the information overload is so high. It's so high that one day I will take a decision, Mithun bhai. एक दिन
Yeah.
मैं ये काम करूंगा. Because of
Right.
that, they keep on, kind of postponing, kind of dilly-dallying, procrastinating. Till that time, let me put the money into my savings account only, or into a bank FD, and then let me one particular day think about what will happen. So I think it's a combination of both.
Yeah.
And the only thing which I basically want to add on and highlight is a very simple data. if our retail inflation, and today
Correct.
obviously, as we are speaking, RBI is holding its monetary policy meeting also. They've just announced a 25 basis hike in the repo rate, which will
Yeah.
further excite people because the FD rates will again go up. Okay.
Yeah.
So
Yeah.
just imagine if I see the past 10 years data, the average inflation, which I call it as CPI. In India, we have two kinds of inflation, WPI and CPI. For us, which matters the more is CPI, Consumer Price Index. For the last 10 years, the average CPI in our country has been hovering close to 7 to 8% average. Okay. And the 1 year FD return, if I talk about post-tax, 20%, 30% tax bracket above 5 lakh rupees, is around 4-5%. So somebody needs to make people realize, somebody needs to make the Gen Z realize that if your inflation is growing by 7-8% and you are actually getting about 4-5-6%, it's actually a decompounding of -2 or -3%.
You're right.
Okay, so people have not, possibly somebody has not gone out there, not spread this particular message that you're actually doing decompounding of your money.
Yeah.
And it's not an FD which remains only for 6 months or 1 year. It keeps getting renewed and renewed and renewed, and the decompounding keeps happening.
Yeah.
So if you really have to grow your income, one is obviously you do good at your job and whatever you are doing, which can be there till a certain age. But if you want to really get your wealth compound, it has to be into meaningful instruments which are positive compounding. That's
Right.
that's the central message.
So you mentioned at the very beginning a very interesting point. When you think about investment, to make the very basic distinction of safety versus the safety of the value. And so let us assume that you've done the homework, you've done that, right? What next? I mean, can you just quickly what else? What comes next in that, like funds, equities,
Yeah.
and yeah,
So as I said, Nikhil bhai, that I think the reason why we basically came into this particular profession is to help our clients in terms of a goal-oriented approach. Okay, a goal-oriented approach. To put a very simple thought, if you are playing football, if somebody is playing football without having a goal post, okay, howsoever hard you may run, howsoever hard you may kick and pass the ball, at the end of the day, there is going to be no goal. So that is the reason why it is extremely important to have a goal-oriented approach. Nikhil bhai, I can share with you a couple of examples, just a
sure.
couple of sample sheets, which will
Yeah,
actually help you in basically understanding how a goal-oriented approach. The one part about today's generation is that they're very target-oriented.
right.
You can actually use it in a positive frame of mind. You give them a target when whatever they are doing, they will say, "Agar main ye target kar lunga, what more do I get?"
Yeah.
They're very target-oriented. If you show them, if you
It
talk
can
to
work as an incentive.
it can work as an incentive. So for the benefit, I've just prepared two sheets and I'll just share them with you. One obviously would be a short-term goal and one would be a very long-term goal. So let's say Nikhil bhai, I have a client by the name Nikhil himself.
Sure.
I'm just broadening this sheet so that you are able to see it. So say Nikhil is 25 years of age, a typical Gen Z who may have just started working since last 2-3 years. The first goal obviously would be to buy a house. Okay. Basically, even if one has to take a debt in a measured approach, which we discussed, buy a house, create a corpus to basically, take care of the down payment part. So let's say the down payment for a house is about 20 lakh rupees in today's terms. How using a goal-oriented approach, a back of the envelope calculation, this Gen Z person called as Nikhil can actually create a corpus which is great for his down payment. So the fund required in today's value could be 20 lakhs. Let's say the house appreciates by 5% every year, typical real estate. And you can change the percentage in this sheet. So if it is 20 lakhs today, assuming an inflation of 5%, it becomes 25.52 lakhs. Okay, by the time this person actually becomes 30 and is on the brink of paying the down payment. To achieve this corpus, what the person needs to do is just start off investing monthly. Okay, it could be an SIP, it could be any other instrument. Just start off something which is at least being able to beat your house inflation. So if your house is rising by say around 5%, you can actually invest into something which gives you say 8% to 10%. So you're able to generate that kind of alpha beyond the inflation. And the figures are very, very simple. Just do a 32,000 investment per month out of whatever salary you are doing. Just maintain it for the next 5 years, and you may stop it thereafter. I think your goal will be reached.
Yeah, so it shows you, I mean, this is a very interesting and a simple, good example of the power of compounding, as you spoke about decompounding versus compounding, and from
Absolutely.
you start and what a difference it can make, how quickly it can make. You can
Absolutely.
30, and then also you showed the 5 and the 10 years. Yeah. Okay. So
Similarly, I'll take another example of say a long-term goal like retirement planning. Something which when I talk about retirement planning to Gen Z, I mean they feel abhi to bahut time baki hai, Mithun ji.
yes.
Why do we need to talk about it right now? That is the reason why I started off with a house, which gives them an instant gratification, and also start off something basically for the long-term gratification.
Mhm.
So somebody who's just 25 wishes to retire at 55. Nobody wants to retire at 60 if you ask a Gen Z person. They say
Yep.
55 is what I have taken. Assuming they survive long because of the medical advancements and good income which they have earned, say 80. If their current monthly expense is say about 50,000 a month, if it is 50,000 a month and considering the monster called as inflation, which we just discussed, if the inflation simply remains at 8%, I've taken the 10 years average of CPI in India. If it costs you 50,000 today to run your house, it will cost you 5 lakh 3,000 per month for
My
living the
goodness.
same lifestyle, Nikhil bhai.
Mm.
Same lifestyle at the age of 55 when you eventually hang up your boots.
Mm. Mm.
Okay, so it's the same lifestyle. Most of us would actually want to upgrade the lifestyle
Yeah.
during retirement. Definitely nobody wants to compromise and downgrade. But even if this
Yeah.
person were to
Yes.
maintain the lifestyle, it costs about 5 lakh. And for getting this 5 lakhs in the first year, and the 5 lakhs again will keep on inflating itself, the corpus which this person needs to generate is close to 10 CRs.
Oh, wow.
Okay.
It can
But
come as a shock when you hear that figure. Yeah.
absolutely. But the best part is then you obviously, kind of handhold the youngster who's there in front of you and you tell him or her, no issues, by still there are 30 years, you've just started earning. Okay. What you simply need to do is close to invest about 30,000 a month, and your salary obviously will keep on rising, but you just need to maintain this particular rate. And with a very, very small amount, every drop will basically eventually turn out into an ocean, and
Yep.
you will actually reach that corpus of 10 crores.
Yeah. Absolutely. So very nice. Thank you. I think this was great to see two very sort of practical goals, one immediate, one long term. And even the long term, of course, they're not thinking about it right now, but it's very, very essential. It enforces, reinforces the point about discipline. And as long as you can just do that, the 10 CR number may seem very big now, but it
Yeah,
really happens much quicker. In fact, it assumes a certain growth. The growth could be even much higher
much higher. Yeah.
goes down, the discipline approach will ensure that it averages at a certain stage. So fantastic. So now, Midhupe, let's you've given some very good tips. You've spoken about the big picture story and the 4 buckets. And so how can we help them just to sustain some of these habits, right? In other words, A is to create the awareness, but now I have gotten some amount of financial understanding and want to create a better life. How do I make sure that I don't fall off the track? So how do we help them to sustain some of these good practices?
I think the best thing how one could actually sustain these practices is please hire a financial planner.
Mhm.
And I'm not telling this because I am on the show, but I can just say
Sure.
that it's very, very important for you to continue earning the way you have been doing. So you simply focus on your work, you simply focus on your business, whatever you are doing. But if you have a financial advisor, if you have a financial planner, if you have a distributor who handholds you, I think it's very important. Please hire them. In fact, when my clients call me Nikhil Bhai, and I just tell them, my job is not to manage your returns, my job is not to manage your funds, my job is to manage you.
Yeah.
Because finally, the behavior is something which is extremely, extremely important.
Yeah.
If you are able to control your behavior,
Yes.
I think 90% of the job is done, and you will be able to achieve your goals. And 90% of the time when my clients call me, they are either into a stage of fear or they are either into a stage of greed. For
Mhm.
me, it is very important to balance them out.
Yes.
Just keep on focusing on what you are doing, everything is fine, just keep on focusing, and don't go into too much of debt, focus on budgeting, keep on saving. As I said, basically, in fact, I'll also share the do's and don'ts as we progress along. That will also
Yes.
give you an idea in terms of how to sustain these practices.
Yes. No, so I think I do want to hear that, but you're right. I think perhaps the culture of seeking up a professional financial planner sometimes can be thought of as that, I can do this, or, why do I need a professional? or what is he going to tell me that I don't know? The information is all available, and also the understanding of the fact that there's a distinction between someone who just sells one product versus someone who is a proper full-fledged financial planner who
That's
actually
right.
can see your financial life through all the 6 areas of financial planning, right? So I think that's a very good point, and hopefully young people are listening to that, because it makes sense to hire an expert and you do what you are an expert at, right? As you say. So now let's go to the do's and don'ts. Let's as
Yeah.
we close out. What are some of the do's and don'ts? Just as a kind of a parting question. What are some of the things that just some basic do's, some basic don'ts, if we have to give them those tips?
Yeah, perfect, Nikhil bhai. So if I talk about the don'ts to begin with, we have already discussed this, but I think it's extremely important. Let me reiterate: don't over borrow. Debt is fine as long as you can manage it. So don't over borrow and regret later. That I would say is the first don't. Second is avoid use of credit cards as much as possible. Third, very, very important point, which we haven't discussed till now, but which people will do, especially in the months of December, Jan, and Feb, is basically let's go all out and invest into any instrument for the purpose of tax saving.
Yeah.
I keep getting calls, Mithunjai, कहाँ पे invest करूँ? I have to
Yeah.
submit it by 4
Which
o'clock
scheme is
today to
there?
my employer. My employer is shouting, my HR is shouting. Don't buy life insurance for investment. I think it's a very, very important point, which youngsters need to understand. They fall into this particular storytelling many a times by the insurance agents and by the banks and everything. Don't buy life insurance for investment. I think this is a very, very important don't. Life insurance per se is an extremely, extremely important part. I would say wealth protection is paramount, then comes wealth creation. But don't buy life insurance for investment. Otherwise, it neither turns out to be insurance nor it turns out to be investment. Okay. So buy life insurance. Which kind of life insurance I will discuss when I come to the do's. So since I'm telling you the don'ts, I said first don't buy. So in very, very simple words, I tell my clients, if you are alive, if you have bought an insurance policy, and if you are alive and the money comes back to you yourself, then there is something wrong with the product which you have purchased. Okay. That's a very important don't. And nowadays, again, since we discussed that the youngsters want information very fast, they're always hooked onto their WhatsApps and social media. I would say avoid excessive news. Is a very, very important don't that I want to share through this program.
Good point. Yeah.
Because today, I think there is very less of news and there is more of noise. I remember 10 years ago, 15 years ago, when we used to hear the word breaking news. Okay, we used to leave everything, whatever we used to do, and we used to simply come to the TV that boss, kuch to aaya. There is something which is
something
very
really
breaking.
bad has happened or something important, right?
Yeah, we need to leave everything, and there is something which is very important for us to digest. Today, I think every 2 minutes you have a breaking and a maha breaking news.
Yes.
And most of the news are, I would say, spreads negativity, which I have seen. So I would say that specifically for today's young generation, it's very important to avoid excessive news. Some of the news are important, some of the news are creates awareness, but a large part of it is noise.
Yeah.
And it just disturbs you. It at times delays your decision making process. So that's very important. Coming to the do's, I would say, as I have said, save first and spend later. So from income minus savings is equal to expenses. If you are graduating to income minus investments is equal to expenses, it's fantastic.
Nothing like
But
it.
at least save karna shuru karo. That is anywhere. That's important. Number two is as I said, focus on wealth protection first and then go on the wealth creation.
Right.
In my firm, all my clients know something called as the EMI. Okay. And when I'm saying everyone should have EMI, people get surprised. Till now I have said don't take too much of an EMI, but when I'm saying everyone should have EMI, so I have my own definition towards EMI, Nikhil bhai, and that is E stands for creating an emergency fund, M stands for having adequate medical insurance, and I stands as having adequate insurance for life. So this is a good EMI to have. Each one of us should have good emergency fund. Each one of us should have adequate medical insurance. COVID has taught us a lot in this regard. Please have adequate medical insurance. Please have adequate life insurance. And if you allow me, I'll just expand on this a little bit. Emergency fund, we were just talking about layoffs, right? So people who have experienced that and who are scared that it may happen to them tomorrow, because they have not only happened in US, some of them have also happened in India as well, right?
Yes.
In spite of the fact that we are not into that recessionary situation, but the ripple effects are happening in other countries as well. So, a simple thumb rule, a very, very simple thumb rule to all viewers of our discussion right now is whatever is your expenses, once you have done that budgeting activity, put in all those expenses and everything, simply multiply that monthly expense, average monthly expense, by around 6 to 12 and put that amount as an aside in an emergency fund.
Right.
I think that is the first step. Even before you start the jazzy part of investing, which is the mutual fund, structured product, everything, first and foremost is the creating an emergency fund, the first step of EMI. Second is have a medical insurance in place. There are very good family floater basic coverage plans available. There are very good family floater super top plans available. Even though your employer is giving you a cover, still I would encourage you should have this own cover. Extremely important. We have discussed this, that beware, please do not mix insurance with investment. But when I'm saying that you should, insurance still is most important, I'm actually emphasizing on having a term plan. So please have a term plan. The good part is today the salaried incomes are good. You can actually get a term plan of 10 times, 15 times, 20 times of your gross income. Younger people generally also do not have any medical issues per se. So it's very important to take a term plan. Extremely, extremely important. So that's why I said these are the 3 steps for wealth creation, wealth protection rather, and then we go to wealth creation. The second do, which I have implemented in my life and I always tell my clients is focus on building as much passive income corpus as early as possible in your life. Whilst we'll prepare your sheets, we'll help you to plan 55, 60, 65. I just showed to you. What is very, very important is have passive income early in life. You may not start to withdraw that, but if you have a good corpus, if you start early, you will be able to create a good corpus. And that feeling that layoff can happen, what if it happens to me, will be much, much milder if you actually have a passive income in place. And last but not the least, as I have always said, have patience. Rome was not built in a day. Have patience. Younger generation should continue with their independent decision making, should take the guidance from a financial advisor, should invest into modern products also, but they should also have the culture, the value systems of their fathers.
Yeah, absolutely.
If my father used to invest into a PPF 15 years ago, he used to put it for 15 years, extend it by 5 years, 5 years, 5 years, do the same thing for the modern instruments. And I'm sure that patience will automatically come.
And you're absolutely right. I think this generation has perhaps the advantage of more information. So you can't complain that there isn't information. They have access to technology, but the mindset and the habit is perhaps the bigger thing. And I think you've shared some excellent do's and don'ts. And I think we can easily make a case that this can go into several episodes. I think we've just surface, but hopefully even just in this first episode or this episode that we've given everyone a quick bird's eye view of some habits that you have seen in the old versus the new, and what are some basic rules that we can think about when you think about budgeting, savings, debt, and income, and of course, some practices to sustain it, and then the do's and don'ts. So once again, Mithun bhai, it's been a very, very informative episode. Really enjoyed it. I sincerely hope that all our young Gen Z generation, listeners, this is especially for them rather than people who actually manage Gen Z. So perhaps even for the parents, is to really appreciate the importance of money and what all things that they can do. So thank you once again, and we look forward to doing more in the future. Take care and all the very best.
Thank you so much, Nikhil bhai, once again for giving me this platform, and I hope that Gen Z, adheres to our discussion. And basically, I think this is the generation. We are fortunate in India to have a younger generation. And I think they can be one generation which can actually take the economy going forward as well. So I hope that whatever you have discussed goes on to them, and I think hoping for the best.
Yeah. Okay. Thank you, Mithun bhai. Take care. See you soon.
Thank you so much, Nikhil bhai.